Have you ever seen the market just lose its mind? I mean, 1 minute it's total panic, a complete free fall of selling, and then, bam, the very next it's an explosion of buying, one of the biggest we've seen in years. Well, that's exactly what just happened, and it has left so many people wondering, what on earth is going on? Okay, let's dive into this and figure out what the machines, the pros, and maybe a forgotten precious metal are trying to tell us.
All right, first up, we really need to get a handle on the sheer speed and, frankly, the violence of this market reversal. It was truly head-spinning.
And this just lays out the puzzle perfectly. Over on the left, you're seeing a massive spike in shorting, one of the biggest this year. That's the panic selling. But then, just a couple of days later, the chart on the right shows an equally insane spike in the opposite direction. We're talking about the largest two-day net buy from the pros in over 6 months. So you gotta ask, what could possibly cause such a violent U-turn? Was it some huge piece of news? Nope, not really.
So the answer isn't in the headlines. It's deep inside the market's plumbing. You see, this wasn't about a sudden change in the economy. It was all about how the market itself is wired these days.
Morgan Stanley's quant team they hit the nail on the head here. They said the drop was mechanical, not a fundamental shift. Think of it like a plumbing problem in your house, not a crack in the foundation. And these kinds of technical flushes, as they call them, often create these incredible buying opportunities for anyone who understands what's really going on under the hood. So what are these mechanical forces? Well, the first culprit has a really weird name, short gamma. The absolute simplest way to think about it is it's a volatility amplifier. It's like a tiny snowball rolling down a hill that just picks up more and more snow, getting bigger and faster. When the market is short gamma, dealers are literally forced to chase whatever direction the market is going. So when prices start to fall, they have to sell more, which makes the drop even faster. And when prices rise, they're forced to buy, which accelerates the move up. It's this crazy, vicious feedback loop. And listen, this wasn't just some theory. This chart right here shows you just how extreme the situation got. That line plunging way down into negative territory, that's one of the most negative gamma positions we've seen. It means that snowball effect was just incredibly powerful. First on the way down, and then snapping back with just as much force on the way up.
But, the dealers weren't the only ones acting on autopilot. Let's meet our second culprit, CTAs. Basically, these are huge computer-driven funds that trade based on preset roles, and a lot of those roles are tied to market trends, and this is the key part, to volatility. And here's exactly what happened. As the market was falling, the VIX, that's the market's fear gauge, you can see it spiking here in red, it just shot up. And for the CTA algorithms, that spike was a giant red alert, a signal to de-risk and de-risk now. So they were forced to puke, and yeah, that's the term they use, and dump billions in stocks right at the market bottom. They were literally pouring gasoline on the fire. So after all that chaos, all that mechanically driven madness, what happens now? Well, let's see how this all sets up a potentially calmer period, at least according to the team over at Goldman Sachs. Their trading desk points to 5 key things. First, that forced CTA selling, it looks like it's pretty much over. Pension rebalancing, not a big deal this time. That short gamma position is still there. Yeah, but without a new panic, there's no catalyst to set it off. And, this is a fun one, a lot of retail traders are on holiday, which can actually take some of the noise out of the market. It all points to a calmer tape.
But you know what? Beyond all of those technicals, there's a much bigger force at play here. Something that's really calming the market's nerves. It's a massive, and I mean a massive, sea change in what everyone thinks the Federal Reserve is about to do. Just look at this. Seriously, look at this chart. This shows the market's odds of a Fed rate cut in December. Just 1 week ago, those odds were sitting at a measly 20%, and today, they're at 80%. That is an absolutely monumental shift in thinking, and it completely changes the game for investors. It gives them the green light, the confidence to jump back into the market. So let's recap. The machines created the sell-off, and then a big shift in Fed thinking calmed the panic. Now, this chaos created what some big players saw as a huge opportunity. So let's follow the money and see who seized it and exactly where they're placing their bets. Okay, so here's the crucial point. While all those automated systems were panic selling, the so-called smart money did the exact opposite. Hedge funds, they went on a buying spree that over just 2 days was one of the largest we've seen in the last 2 years. I mean, they didn't just dip a toe in the water, they dove in head first.
And they weren't just buying everything in sight. Oh no, they had a very clear playbook. On the buy side, it was all about quality. They loaded up on mega cap tech and the US healthcare sector. And what were they selling or shorting? They piled on their bets against non-profitable, more speculative tech companies. This is a classic flight to quality.
And their conviction in healthcare, it's particularly stunning. This isn't just some one-day trade. Look at this chart. The trend has been steadily climbing for months, showing that these funds have been consistently buying into the sector, pushing their total exposure to near record levels. How high are we talking? Well, their positioning in the healthcare sector is now in the 98th percentile for the last 5 years. Let me put that another way. It means they are more bullish on this sector right now than they have been 98% of the time over that entire period. That is an incredibly strong signal of confidence. But hold on. The stock market wasn't the only place where big things were happening. While everyone was glued to those wild swings in the S&P 500, another major story was unfolding, and almost completely flying under the radar. Let's talk about gold. Okay, take a look at this chart. While stocks are going absolutely haywire, gold has been quietly coiling up, tighter and tighter into this classic triangle pattern. Now, for anyone who follows charts, you know this is a classic setup that often comes right before a very big, powerful move. And it kind of looks like that move could be starting right about now. And what's really fueling this potential breakout is what some analysts are calling a golden convergence. You've got 3 totally different, really powerful types of buyers all showing up to the party at the same time: central banks, regular retail investors, and even the calendar itself. This combination is what makes this moment for gold so incredibly interesting. First, you've got the biggest buyers on the planet, central banks. This chart shows their demand, and it has just been relentlessly strong. This isn't speculative hot money, folks. This is a structural, long-term demand that basically creates a solid floor under the price of gold. And second, the retail army has shown up in force. This chart it's absolutely staggering. In just this year alone, individual investors have bought as much gold through the main ETF, GLD, as they did in the previous 5 years combined. That's a tidal wave of new demand that you just cannot ignore. So let's bring it all together, right? The market's gut-wrenching volatility. It wasn't a sign that the economy was falling apart. Not at all. It was a technical tantrum driven by automated systems that were forced to sell at the absolute worst possible moment. And that created a massive opportunity for anyone who understood what was really happening. The machines gave us the dip, and the human investors used it to place their big bets on quality stocks and on gold. The question now is, with that technical storm having passed and the Fed giving us a nice tailwind, does the market just coast into a quiet holiday, or was this violent shakeout the exact fuel needed for a massive rally to end the year? I guess we're all about to find out.